they were talking about getting a 20% or 30% return in a really good scenario, and I'm talking about getting a 10x return in a scenario.
Hey, what's going on, guys? Global economy continues to contract as businesses become more and more vulnerable around the world. In this video, we will take a look at how Chinese manufacturing will affect the entire global economy, and most importantly, I will reveal one in a lifetime opportunity how you can make 10x and even 100x return on your investment in one single trade. This is crazy what is going on in today's market. Dow Jones in one single day dropped by more than 7% at open. Other leading companies were hit hard as well. All FANG companies dropped by more than 7%. Tesla dropped by 12%. In financial sector, banks such as Goldman Sachs, JP Morgan, and Bank of America are also in the double-digit losses, dropped more than 10% at open. Cryptocurrency got a hit too. Bitcoin and other leading cryptocurrencies are in double-digit losses. But look what happened to oil. Oil dropped by more than 22% in one single day. Few weeks ago, it was trading over $54 a barrel. Now it's barely $30. That's close to 50% drop in just a few weeks. Meltdown is definitely happening in front of our eyes, and there is no one that can do something about this. Let's take a quick look at my favorite index, S&P 500. It dropped today as well by 7% at open. I'm pretty sure this is the biggest single day drop since the Black Monday 1987. Back then, S&P 500 dropped by 20% in one single day. Today's drop was not 20%, but it's still a major hit for the stock market. Wall Street had the worst week since 2008 financial crisis. S&P 500 dropped by close to 20% in just a matter of days. If it drops below 20%, we are officially going to enter the bear market territory. We have seen 20% drop already in late 2018. S&P 500 dropped from $2,900 a share to mid-$2,300. That decline was not as severe and fast. It took like 4 months to see 20% drop. Market was able to recover. But this time, we dropped close to 20% in just a matter of 2 weeks. We dropped from $3,400 a share to below $2,800. Are we going to be able to recover? We will, but the question is, when? It doesn't seem like the future is bright for the stock market. I expect more years to come out as global economy continues to contract in the fast rate. The Purchasing Managers Index, or PMI, is an index of prevailing direction of economy trend in the manufacturing and service sector. The PMI is based on the monthly survey sent to the senior executives at more than 400 companies in 19 primary industries, which are weighted by their contribution to GDP. The headline PMI is a number from 0 to 100. A PMI above 50 represents economic expansion when compared to their previous month. A PMI reading under 50 represents economic contraction. Chinese service PMI fell to new all-time low. It dropped from mid-55 to 26. It dropped even below 2008 financial crisis. Even in 2008, service PMI was about 50, but reading 26 indicates that there are some serious problems in economic expansion as people in China do not even go outside or work nor travel anywhere. As we know that China is the biggest manufacturer and the biggest export of goods in the world. For economy to expand, manufacturing and exporting of goods must continue. If not, it will not only affect Chinese economy but also economy around the world. In United States, 95% of S&P 500 companies rely on Chinese manufacturing and export to United States. In China, manufacturing dropped from 50s to 40s, even lower level than the global financial crisis in 2008, which means it will have a ripple effect on other countries, especially on United States. Fearing the US economy would fall into recession, the Federal Reserve pushed through the emergency rate cut the first time since 2008 financial crisis. They lowered its key federal fund rate by half percent point to range of 1% to 1.25%. Most likely, they will continue to cut rate in the near future, and I will show you how you can profit from the Federal Reserve's stupid action. So, don't blink or you might miss it. If the trade plays out correctly, we can make 10x or even 100x return on investment. But first, let's take a look at the quick clip from Anthony Pompliano's podcast with Raul Paul, the CEO of Real Vision, who explains how one analyst made $200 million from that particular trade.
Counter to the narrative, the really big money is to be made at cycle turning points. And the most money of all is the down cycle. And the reason is because the up cycle can take 10 years, like we just had, and the down cycle usually comes in 18 months. So the compressed amount of returns that you can get if you can short things or take advantage of that, move up in bonds, for example, is truly extraordinary.
What is your current portfolio look like, just so as we get into this, people kind of understand how you're actually allocating your capital right now?
So my personal capital is allocated to bonds. I closed some of the position recently. It is dollars, it is gold, and it's Bitcoin.
It's a pretty defensive portfolio.
And I don't think of it in those terms.
Okay.
I think of what I'm thinking of is bonds. I think you can make an extraordinary amount of money, and I've written about Twitter on Twitter, and I retweeted recently about the greatest trade I ever saw, which happened in 2001 when I was trading, and how similar the setup was to today.
Explain that story.
That story is a story of a guy working for a giant hedge fund in London, and the Fed cut, and it's almost identical, the backdrop to today minus the virus, right? So we were going to an economic slowdown. It was pretty clear the Fed had to cut. The bond market starts pricing in Fed cuts. So the Fed then do a cut on, I think it was January the 3rd. Everyone's still on holiday. But this guy comes into the office of this hedge fund outside London, and he goes limit long, according to his risk guidelines, Eurodollar futures expiring that year. Eurodollar futures are 3-month interest rate futures. So he was betting that interest rates were going to get cut significantly. And he gets on a plane and he goes to his house in Mallorca and stays there. And because he can't take any more risk, he's got one trade on, and his view is we're going to recession, the stock market's in a bubble, the Fed are going to have to cut significantly, and the downside of the stock market bubble unwinding is the economy goes into recession. That was his call. So he didn't come back to the office, and eventually there was a pickup in rates as people started fading that narrative and thinking growth was coming back, which is exactly what we got in September, October, November. The ships are exactly the same. In fact, both charts map each other perfectly. The most perfect maps I've ever seen is now versus then. So his boss, one of the most famous hedge fund managers in the world, one of the best risk takers of all time, calls him in and goes, so you've given back a load of money, you've made more money than any other trader at the firm, but you've given back a lot. What do you want to do? And he said, I want to double up.
Really?
And the guy said, why? He goes, because my case is still valid, and I've got profits, and it's my risk to run. And the guy said, fine, do it. Because he understood that the guy had the clarity. There's that moment in time when you have the clarity. And he had the clarity. And he went back to Mallorca. And the reason he was in Mallorca was simple, is he didn't want brokers to call him, his friends to call him, or anybody to persuade you to get out of the trade.
Yep.
And he then returned in November, closed the trade, and retired.
Do we know what the return was?
He made, I believe, for himself, 200 million.
200 million. It's not a bad day.
But again, I don't know quite the numbers, and I won't mention his name because he's a private guy, but phenomenal. And that was one trade. One trade, add, close. That was it.
When you look at that trade to today, is the same opportunity available?
We've just had it.
So
I've been tweeting and talking and shouting and screaming to everybody about this because there's a moment in time when, look, this part of the cycle is what I do. I'm really good at this. Doesn't mean I'm always right, doesn't mean I don't fuck up, but I'm good at this. And I knew that the cycle was turning. And I had a shot in 2016 when we had almost a recession. We had the manufacturing recession, but it didn't follow through. But this time it looked like the stars were aligned and the Fed were going to cut. So I started that whole thing by May with the Eurodollar futures. And then by August I was pounding the table and screaming and shouting.
I remember.
And then basically kept it ever since.
$200 million in one trade? I can't imagine what a douchebag that guy must be. Well, okay, get ready. The question that it raises, how can we position ourselves in order to profit from a period of risk-off market panic without needing to time tops and bottoms with ridiculous precision? The answer that macro hedge fund legend Stan Druckenmiller and many others have arrived to the following. When Fed goes into pause late in the cycle, make a leverage bet on the short-term interest rate going down. The logic behind this idea is difficult to grasp. In the case of slowing down domestic economy, falling stock prices, or lower inflation expectation, and so on, the Fed has few choices. A. Increase rates. B. Cut rates. C. Do nothing. Option A can be eliminated for obvious reasons, and so we're left with option B and option C, which is roughly Fed's position as of today. Essentially, this means that the short-term rates are kept at whatever the current overnight rate is. This means that bearish trader can place leverage bet on the future rate decreases, without having to worry too much about downside. The biggest risk in putting on this trade is the possibility that the Fed will not cut rates in desirable time frame. The easiest way to explain Eurodollar future prices for the purposes is simply 100 minus the market expectation of what 90 days LIBOR will be at the time of expiration date. Suppose that the price for June 2020 Eurodollar future is 99, meaning that the market expects LIBOR to be at 1% low by the end of June 2020. The current LIBOR rate, let's say, is 1.25%. Which means LIBOR rate has to drop by 25 basis points for you to make money being long on this future contract. You will need the Fed to cut more than 25 basis points between now and then, despite the fact that Fed cut already rate by 50 basis points. I don't think it would make any difference if they would cut rates by another 25 basis points or even go to zero. The question is, how soon? But it looks like it will be sooner than later. The nice thing is trading Eurodollar futures with high leverage is quite simple and accessible to most of the retail traders. Some forex trading platforms allow 0.3% to 0.9% margin on Eurodollar future depending on the position size, 333 to 1 and 111 to 1 respectively. Which means if you're right, you can make over 100x your money, but if you're wrong, you would lose your entire investment. That's not all. Let's take a look how John Burbank, a hedge fund manager, executed his Eurodollar future trade.
Now we have a big difference in the perspective of U.S. Fed governors and long-term structural trends that I think creates an unusual once in a 10-year bet that anyone can make, which has really got my focus. And so I guess the point now is what I've seen in almost 30 years is that every 10 years when you get to the end of a cycle, a long hiking cycle, a long growth cycle, and we just made it the longest expansion ever, I think just this week, you have this opportunity or risk of a quick down cycle. And I didn't have the training or understanding about how to use fixed income instruments in 2001 and in 2009. In 2001, I was short a lot of bubble equities, and the S&P went down, and I figured out places to be long that ended up being commodities. That was a great story. In 07, 08, in 05, I identified subprime mortgages as the place to hedge my portfolio. It didn't start paying off until February of 07, and I held it through 2010. I held it a long time. But this is different. There's an opportunity now to hedge yourself through betting on lower rates, and it's entirely different than what I knew before. And so the point of this is, I think there's going to be a lot more policy needed than the Fed governors around the world think. In 2015, which was the after effects of the shocks of the end of QE, where the dollar rose 20%, end of 14 and 15, that created a lot of problems. So anyway, what I like about this trade is that we're not betting on like where will traders mark gold in a year. We're not saying where will the multiple of S&P earnings be. We're not saying, even where will the 10-year trade. What I like about betting on with Eurodollars and betting on Fed futures is that we're betting on where the actual policy rate is going to settle. It's like betting on the earnings, it's like nailing the earnings of an equity, but not having to worry about the multiple.
Right.
It's really, for someone who's done equities, and particularly shorting equities, when you know bad things, if you have positive guidance, you're screwed. So anyway, that gets to this trade, and I've been able to focus a lot of time to learn Eurodollars trade, how calls are priced, and I've come to the conclusion that betting in this situation, once every 10 years, get to the end of a cycle, betting on owning calls, particularly with this leverage, on a lower rate is far, far superior to any other way to hedge yourself. It's far better than owning out-of-the-money puts. It's far better than owning calls in gold. It's really a compelling thing. So that's where it took me a while to get to that point. I wish I had known this, in 07, 08. I wish I'd known this, in 2000, 2001. I mean, rates fell 500 basis points in those two. We only have 7 basis points to go to zero. We are betting on something that's happened before, which is rates dropping dramatically.
Correct.
Right, at the end of a cycle. So that's reassuring. It's just that the evaluation of that possibility has been so limited. We talked to about 10 institutions, and it became very apparent right away that they had no interest for all kinds of reasons. Number one, none of their managers were doing it, right? So number two, it was completely contrary to what they had learned the past few years. So they thought, why would we need this? And third, they no longer thought they really needed a hedge, a tail hedge. We've learned since 2009 that we're going to be taken care of by central banks. Like, things aren't going to get that bad. They're going to go do something. What was funny is that I was basically saying, yeah, and that's why they're going to take rates to zero when there's a problem. So, and you can make 10x on this, and they just weren't interested. They set aside the possibility. It was really like in 506 when it was clear that if home prices do not appreciate for 3 years, the subprime, the triple Bs were going to zero. There was no belief that prices could actually not go up. That's about what the view was among institutions a few months ago about rates. It was just a broad, and it was very helpful, right, to talk to the market and see. So we got no interest, not even a second meeting, and it became clear. Okay, good, that's fine. This is, and you can see it in the how people are betting. They're betting on rate hikes. It was really only to the Fed meeting, this recent Fed meeting, that it was ratified for everyone or clear to everyone. Oh, the Fed actually is probably going to cut. Like, they made it clear. They don't want to cut, because they're looking at the healthy part of the patient, not the weak part right now.
So on your trade, I was just kind of thinking of it like buying those calls on Eurodollar futures, making this long shot bet. It's a little bit like if you think of investing like at Google or Amazon at IPO.
Yes.
If you thought several months ago you could invest in those things at IPO and you could already make 5 or 6 times your money, right?
Yes. Yes.
And now we're at the juncture where many investors
might be turned off by the fact, like, oh, we already missed 180
Yes.
basis points of the move.
That's normal. That's normal behavior, right? We've already missed it.
Yeah, we already missed it. But as you mentioned, in 2002, you could have very easily said, like, I missed 200 basis points of the move, but there was another 250 to come.
Yes.
In 2008, the same thing. And also, we have more information coming in. And if we're
Yes.
always, all the trading wisdom says that
Yes.
most money is made not at the picking the bottoms,
Yes.
but like going with
Middle
a
of
trend
cycle.
when it's
Yep.
middle cycle as a trend established. So your feeling is that that's how investors should be looking at it, that we
Yes.
have right now established trend, which
Yes.
with very high probability takes raise to zero, and people shouldn't look back at when they would have done something.
Yes.
Regardless whether they have position or not, this is a good flow, right?
Yes. So I'm not an expert, but I've been focusing on this for the last 9 months and 6 months, particularly in the $0 calls. And I am long a number of other markets and things. I'm not choosing to be long. I'm long a lot of private, companies, but I'm not choosing to be long NASDAQ and the S&P. I think the multiples are high and there's vulnerability. But what started as a hedge is now the trade, which is kind of like subprime. I did subprime to protect, because I thought to protect my EM and commodity longs that I thought were very vulnerable to a shock, and that became the dominant trade. I'm seeing this as the dominant trade, and it's been reassuring and reinforcing that people aren't positioned for this. They're now positive. So now hedge funds, et cetera, are now positive. But Raul has told me, I trust his view of canvassing the street, that almost nobody has had the trade on. That's reassuring to me, right? Because if this is real, they're going to have the trade on. So it's just gone positive in terms of exposure. What's interesting is that I always thought that equity people were willing to take more risk, played for bigger stakes, and fixed income people were the opposite, right? They're going to be conservative, or bond market people conservative, and that you attracted a different, kind of personality. So what I've talked to people who just do fixed income about this, or institutions say, oh yeah, I've got that trade on, and I'm like, what is the trade? Oh, well, I'm long, 10 years, I'm long 5 years, I'm long 2 years. And then the question is, well, how levered up are you? How confident is this bet? Usually, they were talking about getting a 20% or 30% return in a really good scenario, and I'm talking about getting a 10x return in a scenario. And so, in a way, I'm bringing a risk-seeking mindset to this trade for a lot of people who aren't used to having this maybe optionality or aren't seeking this kind of risk. I now can understand why Druckenmiller could have made so much money, in these times, right? A risk-seeking mentality in an incredibly liquid, leverageable, area. I get it. I get that now. And if I had to do my career differently, I would have been trained about rates on the sell side early in my career, so I could have made this part of it.
Let me know what do you guys think about this one-in-a-lifetime opportunity to make lots of money. Leave your thoughts in the comment section below, hit that like button and subscribe.